Imagine you're the most powerful economic institution on the planet. You have 190 member countries, $1 trillion in lending capacity, and a team of the world's sharpest economists running models 24 hours a day. You've seen recessions, wars, pandemics, currency collapses. You've seen it all. And then, one morning in April 2026, you publish a number. Just one number, 3.1%. That's it. That's the global growth forecast for 2026. Doesn't sound scary, right? In fact, it sounds fine, reasonable, almost boring. But here's the thing. That number is a mask. Behind it sits a second number that IMF economists are quietly whispering about in Geneva and Washington, 2.5%. And that number? That's the scenario where everything starts to break. So today, we need to ask three questions. Why is 3.1% actually a 5-alarm fire dressed up as a weather report? What combination of forces, population collapse, active wars, and a debt supercycle is quietly building towards something the IMF is calling an adverse scenario? And most importantly, are we already in it? Stay with me, because this is the most important economic story that most people aren't watching closely enough. To understand why 2026 feels different, you need to go back to 2023. The global economy had just survived the COVID hangover. Inflation was brutal, 8%, 9%, 10% in major economies, but central banks were fighting back. The Fed raised rates 11 times. The ECB followed. The narrative in every financial newspaper was the same. Yes, it hurts now, but we'll engineer a soft landing. And for a while, it actually looked like they might pull it off. US GDP held. Europe didn't collapse. China was supposed to roar back after COVID lockdowns ended. The key players were confident. Jerome Powell at the Federal Reserve, Christine Lagarde at the ECB. The IMF's own Kristalina Georgieva was cautiously optimistic through 2024, calling for resilience and careful navigation. The World Bank echoed the same language. But here's where nobody was talking about loudly enough. Beneath the headline numbers, three structural fault lines were quietly widening. A demographic crisis decades in the making, a war in Eastern Europe that refused to end and metastasized into a broader geopolitical realignment, and a global debt load that had ballooned to $313 trillion by late 2024. That's roughly $39,000 of debt for every single human being alive on Earth. The before picture looked manageable because the surface was still intact, but the foundation was cracking. But here's where it gets interesting. Let's start with the number itself. 3.1% global growth sounds decent. Historically, global GDP growth has averaged around 3.5% over the past 50 years, so we're slightly below average. Big deal. Here's the big deal. That 3.1% is not evenly distributed, not even close. When you strip out India, which the IMF projects growing at 6.5%, and a handful of emerging Southeast Asian economies still riding a demographic dividend, the picture for the rest of the world turns genuinely ugly. The United States is projected at around 1.8%. Germany, the economic engine of Europe, has been hovering near zero growth, with a technical recession already recorded in 2024. Japan, structurally stagnant, and China, officially around 4.5%, but independent economists have been putting the real number closer to 3% for years. Do the math here. If you're an advanced economy, 1 to 2% growth while carrying debt to GDP ratios of 100%, 120%, 130%, you're not growing. You're treading water while wearing a concrete jacket. The IMF's own language in their April 2026 World Economic Outlook is telling. They describe current conditions as the weakest medium-term growth outlook since 1990, not since the 2008 financial crisis, since 1990. That's 35 years of economic history, and they're saying we're at the bottom. We're just getting started. In the next section, let me show you the first crack in the foundation. Quick pause. If you're realizing that demographic data is the most underreported economic story of the decade, you're absolutely right. Hit subscribe because we go deep on these structural forces all the time. Now, here's the paradox of our era. For 50 years, economists and scientists warned about overpopulation. Paul Ehrlich's 1968 book, The Population Bomb, predicted mass starvation. The whole world was terrified of too many people. Plot twist: the crisis is the exact opposite. Fertility rates globally have collapsed. In 1960, the average woman on Earth had 5 children. Today, 2.3. And in the countries that actually drive economic output, South Korea, 0.72. That's the lowest ever recorded for any country in human history. Italy, 1.20. China, 1.09. Despite a government literally paying couples to have babies. Spain, Japan, Germany, all well below the 2.1 replacement rate needed just to maintain population. Here's why this is an economic catastrophe and not just a demographic curiosity. Growth requires workers. Workers produce goods and services. Workers pay taxes that fund government debt. Workers buy houses, cars, smartphones. When you have fewer workers, you have lower productivity, shrinking tax bases, and, here's the kicker, an exploding elderly population that consumes healthcare and pensions while producing nothing. Japan is your case study. Japan's working-age population peaked in the 1990s. What happened next? 3 lost decades of near-zero growth. The Nikkei stock index didn't recover its 1989 high until 2024. 35 years. That's not a recession. That's a slow-motion economic suffocation. Now, imagine Japan, but at a global scale, because that's precisely what the IMF's medium-term models are incorporating. Now here's where the story takes a dark turn. The Russia-Ukraine war entered its 5th year in 2026. NATO members have collectively spent over $250 billion in military aid and direct support. Europe has permanently restructured its energy infrastructure at a cost economists estimate above $300 billion. That's $300 billion not spent on hospitals, infrastructure, or productivity investment. But the financial war isn't just in Europe. The Red Sea crisis, which exploded in late 2023 when Houthi attacks began targeting commercial shipping, has never fully resolved. At its peak, shipping costs on key global routes rose by 300%. Container rates that were $1,500 in 2019 hit $6,000 and beyond. When shipping costs go up, everything goes up. Electronics, food, medicine, clothes. It's a hidden tax on every consumer on the planet. Let's do the math on what geopolitical fragmentation actually costs. The IMF themselves published a working paper estimating that deep geoeconomic fragmentation, think the world splitting into US-aligned and China-aligned trade blocs, could reduce global GDP by up to 7% in the long run. 7% of a $110 trillion global economy is $7.7 trillion, gone permanently every year. That's larger than the entire GDP of Germany and France combined, evaporating annually because countries can't move goods efficiently across borders anymore. And here's the mini mystery I want you to hold in your mind. That fragmentation isn't hypothetical anymore. It's already happening. We'll come back to exactly how catastrophic it's becoming. This is the section that should genuinely keep you up at night. Global debt hit $313 trillion in 2024, according to the Institute of International Finance. That's 333% of global GDP. To put that in perspective, in 2000, global debt to GDP was around 230%. In the decade after the 2008 financial crisis, instead of deleveraging, paying debt down, the world doubled down. Governments borrowed to bail out banks. Central banks held interest rates at 0 for a decade, making borrowing essentially free. Corporations leveraged up, households leveraged up. When interest rates were zero, carrying $313 trillion of debt cost almost nothing. But here's the brutal arithmetic. When global rates moved back toward 4 to 5%, the annual interest cost on that $313 trillion is somewhere between $12 and $15 trillion per year, just in interest, not paying down principal, just servicing the cost of the debt. That's larger than the entire US federal budget, and it's money that cannot be invested in AI, clean energy, healthcare, or anything that generates future growth. The IMF specifically flagged in 2026 that sovereign debt stress in emerging markets represents one of the top 3 risks to the global outlook. Countries like Egypt, Pakistan, Argentina, Kenya, they're not facing recession. They're facing something closer to economic collapse, where debt repayments consume 40 to 50% of government revenue, leaving almost nothing for basic services. This is the economic boa constrictor. It doesn't kill you fast. It just squeezes slowly, year after year, until breathing becomes impossible. Here's what the IMF will say, buried on page 47 of their World Economic Outlook. Under an adverse scenario, a combination of escalating trade tensions, tighter than expected financial conditions, and deepening geopolitical conflict, global growth could fall to 2.5% in 2026. Economists call growth below 2.5% a global recession, not technically by the traditional definition, which requires negative growth, but a global recession by any practical measure, because at 2.5%, with global population still growing, per capita income actually falls in large parts of the world. This is where it gets crazy, so stay with me. The adverse scenario isn't a black swan. It's not some once-in-a-century catastrophe. It requires just 3 things to happen simultaneously. A new escalation in the Russia-NATO-Ukraine situation, a US-China trade conflict that pushes tariffs above 50% on a broad range of goods, and a credit event in one major emerging market that triggers contagion, meaning investors panic and pull money out of multiple fragile economies at once. As of April 2026, 2 of those 3 things have essentially already happened. US-China tariffs passed 50% on targeted goods in early 2026. Emerging market credit spreads, the extra interest rate premium investors demand for holding risky country debt, have been widening for 18 months. We are one significant geopolitical escalation away from the IMF's worst-case scenario becoming the actual scenario. You cannot tell this story without going deep on China. And no, the narrative is not China is collapsing. The real narrative is far more nuanced and far more dangerous. China's real estate crisis, which began with Evergrande's 2021 default, has never actually been resolved. Over 50 major Chinese developers have defaulted or restructured. An estimated $2.4 trillion in real estate wealth has been destroyed on paper. In China, real estate represents roughly 70% of household wealth. When real estate falls, Chinese consumers stop spending. When Chinese consumers stop spending, every country that sells China commodities, luxury goods, or manufactured components feels it. Australia, which sends 35% of its exports to China, has been experiencing exactly this slowdown. Germany, which built an entire industrial strategy around selling cars and machinery to the Chinese market, is facing its most severe competitiveness crisis since World War II. And here's the deeper issue. China's working-age population peaked in 2015. It's been declining for a decade. By 2035, China will have more retirees than workers. The world's second-largest economy, the engine of global growth for 30 years, is demographically entering its own slow-motion Japan phase. That is a structural shift that no stimulus package and no property bailout can reverse.
The moment that crystallized how serious 2026 had become wasn't a single dramatic crash. It was something more insidious. It was a convergence. In early 2026, the IMF revised its global growth forecast downward for the fifth consecutive year, not catastrophically, just quietly, steadily, relentlessly downward. 4.0%, 3.8%, 3.5%, 3.3%, 3.1%. Each revision accompanied by careful, measured language. Each revision representing trillions of dollars in economic activity that simply never materialized. Simultaneously, central banks found themselves caught in an impossible trap. Inflation hadn't fully died. Persistent services inflation and supply chain reshoring costs kept prices elevated, but growth was weakening. If you raise rates to fight inflation, you crush growth further. If you cut rates to stimulate growth, inflation reignites. Economists have a word for this trap: stagflation, and it's the nightmare scenario that every monetary policymaker spent 2025 desperately trying to avoid talking about, because the moment you say the word out loud, you risk making it worse.
Who won in this environment? Hard assets. Gold hit $3,200 per ounce in early 2026. Defense contractors posted record profits. Energy companies, particularly LNG exporters, saw revenues surge as Europe locked in long-term supply contracts at premium prices. Who lost? Everyone who borrowed to grow. Every startup that raised money at 2021 valuations. Every government that promised social programs funded by perpetual growth. Every middle-class family in an advanced economy watching their purchasing power quietly erode while the headline number said everything was fine. The breaking point is never when the number goes negative. The breaking point is when enough people simultaneously realize that the story they were told, that growth would return, that central banks had it under control, that the fundamentals were sound, was a story that depended on conditions that no longer exist.
Now, before you sit back and think this is abstract macroeconomics that doesn't touch your life, let's be very direct. The last time the IMF issued a weakest medium-term growth outlook in 35 years assessment there was no last time. This is the first time. This is unprecedented language from the world's most cautious economic institution. This is the canary in the coal mine, and the canary is not chirping. The countries most exposed? Any nation running large fiscal deficits while dependent on foreign capital, and there are dozens of them. The sectors most exposed? Commercial real estate globally, which never recovered from the post-COVID remote work shift, regional banking systems holding commercial real estate loans, and consumer discretionary spending in middle-income economies where household savings rates have returned to near zero. The pattern emerging today rhymes almost perfectly with 1997-1998, when Asia looked fine, then Thailand devalued its currency, and within 18 months, South Korea, Indonesia, Malaysia, and Russia had all experienced financial crises. Contagion is not a historical curiosity, it is a live mechanism, and the 2026 version has a faster transmission speed because $7.5 trillion in daily foreign exchange trading means capital can flee a country in hours, not months.
3 things to take from this story. First, growth numbers are a narrative, not a reality check. 3.1% global growth sounds acceptable, but when you disaggregate it, when you look at who's growing and who's stagnating and why, and when you layer in the debt service costs eating that growth from underneath, the actual picture is dramatically darker than the headline suggests. Always look beneath the number. Second, the triple threat is what makes 2026 genuinely different from previous slowdowns. Demographics, geopolitical fragmentation, and debt supercycle are not 3 separate problems. They are 3 mutually reinforcing problems. Fewer workers means less growth to service debt. Geopolitical conflict raises the cost of everything, which increases inflation, which keeps rates high, which makes debt service more expensive. These are feedback loops, and feedback loops, once they gain momentum, are extraordinarily hard to stop. Third, and this one matters to you personally, in every major economic disruption in history, the people who came through it well weren't the ones who had the most money. They were the ones who had the clearest information the earliest and adapted fastest. Understanding that we may be in the early innings of a structural global slowdown, not a temporary dip, but a genuine multi-year reorientation of the global economy, is itself an enormous advantage. Knowledge, deployed early, is economic armor.
So here's the question I'll leave you with. The IMF is projecting 3.1%. Their adverse scenario is 2.5%. But what if both numbers are optimistic? What if the real adverse scenario, the one that incorporates full geopolitical fragmentation, an uncontrolled Chinese real estate unwind, and a demographic cliff happening simultaneously across 5 major economies, what if that number is something nobody is publishing yet? The IMF, for all its brilliance, has a track record of being late. They didn't see 2008 coming with sufficient urgency. They didn't predict the inflation surge of 2021 with sufficient clarity. They are, by institutional design, careful and measured and conservative in their public communications, which means when they say adverse scenario of 2.5%, you should probably ask what the scenario below the adverse scenario looks like. If this video gave you a sharper lens for reading economic news, drop a comment below with the one number from this video that hit hardest. And let me know, do you think we're already in the adverse scenario? Because I think that debate is worth having. Next video, we're going deep on the one sector that has historically grown during every global slowdown of the past century, and why 2026 might be the exception that breaks even that rule. See you there.